So first of all, Mike, actually, I would like to ask you, when are we gonna see the euro get touch its lowest point here?
Well, it's really a matter of whether or not you're talking about the near term or the far term. I think that the dollar is just starting a very long-term cyclical recovery. As the Fed begins raising interest rates in the next year or two, growth differentials will also come to the aid of the dollar. You could see something on the other side of parity versus the euro. But I think more near term, the concern is this summer, given continued deterioration in conditions in terms of market sentiment and uncertainty surrounding Europe and the sovereign debt issue, that's a completely separate issue. And there, certainly 120 is an objective. I think a lot of market players are looking at the launch rate at 118.
And what do you think, Yun?
Well, we believe that the euro is headed down to $1.15 by year's end, and a lot of this is based on purchasing power parity as it stands. The euro has been overvalued vis-a-vis the dollar for quite some time, and that's one of the reasons why certain European economies have gotten into some trouble. So it's important, I think, to have the euro move lower in order to enhance the competitiveness of European economies.
And also, we talked about what is going on right now in Europe. So first of all, let's talk about short sellers. Do you guys think that there's any risk there? There's a real short selling position that it's lowering the value of the euro?
Well, as I said earlier, the euro was overvalued not very long ago. It was grossly overvalued when it was at $1.40, and I still think it's somewhat overvalued. So I wouldn't necessarily blame the euro's latest decline on short sellers.
Well,
Michael?
Germany has chosen to take the position of banning the short selling of certain instruments. I believe some of the largest of their bank equities, euro-denominated government bonds, and some of the derivatives surrounding those. Look, that's only, I think, a temporary solution to a longer-term and more fundamentally structural problem that in foreign exchange, short selling is commonplace, and there's no way to ban short selling in foreign exchange markets. And there you're looking really at market players expressing a view, and certainly markets will overshoot, and they commonly do in foreign exchange. And yes, the euro is probably a little oversold and the dollar a little overbought here, but the clear direction is lower.
And we're also referring to Europe and the debt crisis there. Are we going to see any other countries going through the same path as Greece, like, for example, Spain?
This time we hope not, and it could very well be that forceful action by the authorities in Europe will prevent contagion from resulting from the problems now facing Greece.
And you, Mike, do you think that we're going to...
This is not a garden variety crisis, and it won't have a garden variety solution, which typically is a depreciation of one's currency and restructuring one's debt. That's prohibited as the rules stand now. And I think it'll take a great deal more pain before the necessary decisions are made. And I think the necessary decisions is to change the laws governing the Eurozone. And there I think we have some latitude. I think either you choose fiscal union, which is I think perhaps what France is championing right now, or what may very well be a German position developing this summer, that you can't bail out everyone, and that having fiscal unity is just simply too expensive, at least those for deep pockets. So an exit clause for those that are chronic non-compliers with the Growth and Stability Pact, or simply those that no longer want to participate in the Eurozone, may have to be written into the law.
And also, so do you think, guys, that all the answer that the European Union is given to the whole situation with this big bailout, just in case any other country needs that money, is the right path to go, or we should have let Greece default and go bankrupt?
I think for the near term, you really have no other choice but to supply extraordinary support to those European governments that are running into some difficulty meeting their debt servicing obligations.
You, Mike?
I think that, that's absolutely correct. You do your best. No one wants to see a crisis erupt into worst case scenario, depreciation, whatnot. So you do your best. Unfortunately, by the time that rescue packages are considered and implemented, it's probably already too late. In terms of Greece, so some of the numbers that I've seen is that after this coming 3 years and the application of rescue funding, they're still strapped with total debt to GDP of roughly about 150%, and their debt service roughly about 25% of tax revenues. I suppose it's possible, but this would be austerity measures as far as the eye can see. That's I think, difficult for anyone. So I think really it's going to take time to come to this, but a temporary move outside of the Eurozone, a depreciation, debt restructure may be the best alternative for Greece.
And there's much, we have talked also a lot about the possibility of U.S. getting a hit from what is going on in Europe. Do you think, or both of you think, that there's any risk of that really happening or not?
I think there is. I mean, already we find that there has been a slump in the equity market, highly volatile stock prices, and with this, pronounced widening of credit spreads. That pronounced widening of credit spreads threatens to delay a normalization of the U.S.'s credit market as far as the availability of funds to consumers and small to mid-sized businesses go. And moreover, we've had a drying up of high-yield bond issuance and corporate bond issuance, which, if it lasts long enough, would damage the U.S. economy. Stock markets are very important. This steep slide in the stock market of the United States could prompt some companies to postpone capital spending plans that would include taking on new employees. And moreover, one of the reasons why U.S. consumer spending has exceeded expectations earlier this year, and now other reason why consumer spending is growing more rapidly than consumers' incomes, is because of a very powerful stock market rally. First quarter market value of common stock in the U.S. is up 42% from a year ago. If stocks start moving lower, that would adversely affect consumer spending and imply that the U.S.'s economic recovery will be more anemic than otherwise.
And you Mike, do you have to?
I take a slight issue with that. Certainly, I take the point that the green shoots rally a year ago was predicated on a persistent rally in equity prices. However, you take a look at other things like the post-cash for clunkers performance in manufacturing, the U.S. industrial production, and it's a little less obvious that it was driven by equities purely. There is something fundamentally positive happening in the U.S. economy, whether or not you look at manufacturing and industrial production, whether you look at the amount of fiscal stimulus currently in the pipeline. Consumers right now are still very pessimistic, even putting aside the recent consumer confidence report, which proved to break the expectations to the top side here. The flash crash was certainly linked to problems in Europe and had a negative impact on sentiment, both market as well as the consumer. A lower stock market certainly is going to be negative for the consumer, but isn't the consumer right now that is driving the economy? Once we get unemployment lower, that will have a primary impact. I mean, World Bank's Robert Zoellick had indicated several days ago that he really kind of brushed aside concerns that Greece could cause a knock-on effect globally, given how small it is. Certainly, it's going to have the potential to impact financial markets, but I think that that's only a temporary phenomenon.
And now that we see that the Obama administration has ended all those fiscal credits for new buyers of real estate, we're gonna see a recovery, or we're gonna see